Okay, let's just jump right in. We are sitting here, it's 2026,
It is.
and the market is, well, it's doing what it always does. It's moving. The charts are painting these massive green and red candles that give us all heart palpitations.
Yeah, that part never changes.
Never. And everyone, I mean, absolutely everyone is trying to figure out the exact same thing. Are we heading for the moon, or are we about to head straight back into the dirt?
It is the eternal question, isn't it? The year changes, the tech evolves, but that specific pit in your stomach, when you look at a volatility chart,
Say please the same.
that stays exactly the same.
It really does. But here's the thing about today's deep dive. We aren't just, speculating. We're not just looking a finger and holding it up to the wind to see which way it's blowing.
No.
We have a stack of sources today that represent millions of dollars in hard-earned lessons. And I mean that literally.
Literally millions.
Yeah.
The tuition in this market is very expensive.
We're looking at insights from some veteran traders like Virtual Bacon, who has been incredibly public about his journey. He's documented making millions, then losing it all, which is the really painful part.
That's the learning part.
And then making it all back again. Plus, we've got the deep structural analysis from teams like Coin Bureau. We are talking about basically a shortcut to 7 years of trading knowledge, all condensed right into this deep dive.
And that's a very expensive tuition to pay for yourself. I mean, if you've been in this market for any amount of time, you know that the word experience is usually just a nice way of saying all the money I lost learning how not to lose money.
Oh, exactly.
The whole goal here is to let someone else pay that tuition so you don't have to.
Right. We're synthesizing all their trading scars, all their analysis to build what we're calling a survival and profit guide for where we are right now in 2026. Because let's be honest, if you're listening to this, you're probably wondering why the strategies that worked so well back in 2020 or 2021, they feel a little bit shaky recently.
They feel broken. That's the key. The game has changed. The market has matured. The players are different. There's more capital, more institutions.
Yeah.
We're moving from what was essentially gambling.
Right.
Just throwing money at a ticker symbol because it had a cool logo or a funny name, to what we need to start thinking of as strategic asymmetry.
Okay, unpack that. Strategic asymmetry.
It's about finding bets where the potential upside is just massively disproportionate to the downside. And you can't find that if you're listening to the noise.
So the mission is to find the signal.
To ignore the noise, find the signal. And to do that, we have to start by just shattering some of the biggest myths that have been, frankly, leading people right off a cliff for years.
Let's do it. Let's jump right into the biggest one. The holy grail of crypto timing. The 4-year cycle.
The halving cycle.
The halving cycle. Everyone knows this, right? Bitcoin halves its issuance every 4 years. The supply gets cut, so the price goes up. It's clockwork. It's a calendar event. It's basically religious doctrine at this point in crypto. But our sources are suggesting that relying on this right now in 2026 is actually dangerous. Why is that?
It's a very controversial take, but it's a necessary one. The counter thesis that's being presented in our research is that the 4-year cycle patterns we've seen in the past are largely coincidental.
Coincidental. That feels like blasphemy. I mean, are you saying the halving, the core economic mechanism of Bitcoin, doesn't matter?
No, it matters. Of course it matters. It has an effect on the supply side, but it's not the primary driver of price anymore.
Okay.
If you look at the data overlays, the argument is that the real driver of these huge bull markets isn't the internal code of Bitcoin. It's macro liquidity.
Yeah.
It's the M2 money supply. It's what the Federal Reserve is doing with its balance sheet.
Okay, let's unwrap M2 money supply for a second. We hear this term thrown around by economists and on financial news, but what are we actually looking at? What does it mean for the average person?
Simply put, M2 is a measure of all the cash and, easily accessible money like checking deposits in the system. You can think of it as the global ocean of money.
Okay, an ocean of money. I like that analogy.
And when central banks turn on the printers, like they did in a massive, unprecedented way in 2020, that ocean rises.
And a rising tide lifts all boats.
Lifts all boats. Stocks, real estate, fine art, and especially the riskiest, most volatile assets at the far end of the spectrum, like crypto.
So the theory is that the previous Bitcoin halvings in, say, 2012, 2016, 2020, they just happened to line up with times when the Federal Reserve and other central banks were expanding the money supply, pumping liquidity into the system.
Exactly. It was a beautiful correlation, but it wasn't necessarily causation. The fact that the halving cycles lined up so perfectly with these global liquidity expansion cycles gave us this false sense of a predictable crypto-native calendar.
So we thought Bitcoin was moving to its own beat.
But it was actually just dancing to the Fed's tune the whole time. We were looking at the wrong conductor.
And that's how we got trapped in a narrative. I remember it so clearly back in 2021. Everyone was screaming, super cycle.
Oh, the super cycle.
The narrative was, this time is different. And we aren't going to have a major bear market because institutional adoption is finally here.
Precisely. And that narrative was a trap. It caught so many people. Think about the psychology there. If you truly believe in a super cycle that's driven by a pre-programmed calendar event, what do you do?
You hold. You never sell. You diamond hand it.
You hold your positions. You ignore all the warning signs from the macro environment. You hold all the way down from the highs because you're looking at a calendar on your wall instead of looking at what the Federal Reserve is broadcasting to the world.
And Virtual Bacon, one of our key sources for this, he admits he fell for this.
He does. He's very open about it. He admits he got trapped in this exact headspace. He held on to positions way too long in late 2021 and into 2022 because his cycle models told him we had more time. We were supposed to have a blow-off top in Q1 of 2022.
But it never came.
It never came because he was ignoring the fact that the Fed was very publicly saying, we are going to hike interest rates aggressively and pull all this money back out of the system.
Ouch. That is a painful, expensive lesson.
So the actionable takeaway for us right now in 2026 is don't try to predict the Bitcoin top or bottom based on a date on the wall. Watch the money printer.
Exactly. Watch the liquidity. If the central banks are tightening policy, the halving won't save you. It might create a small upward pressure, but it's a candle in a hurricane.
Right.
But if they're printing money, if they're easing, you could be in a raging bull market regardless of where we are in that so-called 4-year time frame. The macro environment trumps the code. That
leads perfectly into the next major concept, which is trend theory. There's this old saying, the trend is your friend. That sounds like something a kindergarten teacher would say, but in trading, it's viciously important.
It is everything. It is the difference between swimming with a strong current at your back and trying to swim against a tsunami. And most people, especially in crypto, get it wrong because of one very specific ingrained habit.
Which is?
Buying the dip. Wait. Buying the dip is bad. That's like rule number 1 of crypto Twitter. BTFD. You see it on every post. How can buying low possibly be a bad strategy?
Buying the dip is a fantastic strategy. If you are in an established uptrend,
okay,
if the overall market structure is moving up, you're seeing higher highs on the chart and higher lows, then a dip is a discount. It's a sale on an asset that's already proving its strength. But here's the trap. If the market structure has flipped to a downtrend, buying the dip is just a slow, painful way to set your money on fire.
Because in a downtrend, the dip isn't really a dip. It's just the next step down on a very long staircase.
Right. You're catching a falling knife. You're trying to find the bottom. And the market can stay irrational and keep falling way longer than you can stay solvent. In a downtrend, the strategy completely flips. You should not be buying dips. You should be selling the rips.
Selling the rips. I like that phrasing. Explain the mechanics of that. What does that look like in practice?
It means that every time the price has a relief bounce, a small rally in an overall bear market, that is your exit liquidity. That is your opportunity to get out of your long positions or even to go short.
So you're selling into that brief moment of strength.
You're selling into the optimism of people who think the dip is over. The source material highlights how many traders just bleed out their entire accounts because they keep buying these dips that just keep getting deeper. They think, oh, it's down 20% from the high. It has to bounce here.
Famous last words.
No, it doesn't. It can go down another 50% from that point.
It's the difference between buying a luxury handbag on sale at the store and buying a ticket for the Titanic after it's already hit the iceberg.
A grim analogy, but a very accurate one.
Yeah.
And then there's the third state of the market, which is where we spent a lot of time recently, and it's maybe the most psychologically damaging of all.
The chop.
The chop. The sideways grind.
Ugh, the chop.
That's sideways purgatory. I remember looking at the Bitcoin chart in mid-2024. It felt like an eternity. We were just bouncing between, what, $55K and $70 for like 7 months?
It was brutal, and that boredom is a weapon. The market uses the chop to destroy confident traders.
How so?
Our sources point out that during that specific period, Bitcoin was essentially flat on a macro scale, yet trader sentiment completely collapsed. People became extremely bearish at the bottom of the range. Why?
Because they were getting worn down.
They were getting worn down. They kept trying to force trades that weren't there. They'd buy a breakout above 70K, thinking this is it. We're finally going to 100K, and it would get smacked down. Then they would short a breakdown below 60K, thinking it's over, we're going to zero, and it would bounce right back up.
And it wasn't just Bitcoin. I mean, the altcoins were getting absolutely hammered during that sideways action. I remember seeing Phantom drop from over $1 all the way down to 30 cents. Superverse went from $1.50 to 40 cents. That just wears you down mentally. Exactly. And the real tragedy is that many people sold the absolute bottom of those moves because they lost all confidence. They looked at the sideways, boring price of Bitcoin. They saw their altcoin bags bleeding out day after day, and they just capitulated. They couldn't take the pain anymore.
And they did that right before the next leg up.
Right before. But if they had just zoomed out, if they'd looked at the macro structure, they would have seen that the overall uptrend hadn't actually been broken. It was just consolidating. It was building energy.
So the actionable advice for dealing with choppy sideways markets is what? Just do nothing.
Often, yes. Doing nothing is a valid and often the most profitable position you can take. Protecting your mental capital is just as important as protecting your financial capital.
That's a great point.
If the market isn't giving you a clear trend, if it's not giving you a high probability setup, you don't have to trade. You can just sit on your hands and wait for the signal.
I love that. Doing nothing is a position. It's so much harder than it sounds, though. We feel like if we aren't clicking buttons, if we aren't in a trade, we're not working, we're missing out.
That's the dopamine talking. That's the gambler's mindset. Real professional trading is 90% waiting and 10% pure aggression when the moment is right.
Okay, let's pivot from market structure to the assets themselves. We're talking about surviving and profiting in 2026, so we need to know what we're actually buying. I think a lot of people, even now, use the words coin and token interchangeably, but there's a really distinct and important difference, isn't there?
There is, and understanding this difference is fundamental to risk management. It's step one. Think of the entire crypto space as a new digital asset class. Our source from Coin Bureau uses a great analogy. Imagine a stock certificate. In the old days, you had a physical piece of paper with a serial number on it. That was your proof of ownership. Today, in the stock market, you just have a digital entry with that serial number assigned to you. Crypto is basically that serial number, but without a central company like the DTCC keeping the ledger. The network itself is the ledger.
Okay, so that's the broad definition of a digital asset. But within that, what separates a coin from a token?
It all comes down to the architecture. A coin is the native asset of a blockchain. It's the digital electricity that runs that specific computer network.
So Bitcoin is a coin.
Bitcoin is a coin because it's the native asset that runs the Bitcoin network. Ether is a coin because it's the gas you need to operate on the Ethereum network. Solana is a coin. These are the layer ones.
The base layers.
The base layers. And developing a secure, decentralized layer one blockchain is incredibly difficult and expensive. It takes years and hundreds of millions of dollars. That's why there are only a few dozen coins that really matter in the grand scheme of things.
And tokens, then, are the applications built on top of those base layers.
Precisely. Tokens are the applications built on top of those blockchains. Think of them like the apps on your smartphone. It's relatively easy to build an app compared to building the entire iPhone operating system from scratch.
Right.
And because it's so easy to create a token, you can launch one in minutes now. There are millions of them. And statistically, just like in the App Store, most of them are completely worthless.
So generally speaking, from a risk perspective, coins have a higher floor value because they represent the core infrastructure, while tokens are much more speculative bets on specific applications that could go to zero.
Correct. Coins usually hold their value longer and are more resilient in a bear market. Tokens are where you might find that insane 100x or 1000x explosion because a specific app goes viral, but they're also where you find almost all of the zeros. If a DeFi app fails, its token becomes dust. But if that app fails on Ethereum, Ether is still Ether. It still has intrinsic value as the fuel for the whole ecosystem.
Speaking of finding those 100x explosions, we have to talk about one of the biggest psychological traps in all of crypto. I think this gets almost every single newbie. It's called unit bias.
The cheap coin fallacy. It's so dangerous.
It's that feeling you get when you see a coin that costs, $0.00001, and you think, wow, if this just goes to $1, I'm buying a private island.
It's an incredibly powerful psychological pull, but it's based on a complete misunderstanding of value. You have to look at the market cap, not the unit price.
Walk us through the pizza analogy here. I think this is the best way to visualize it and really make it stick.
Okay, so imagine a pizza. The total size of that pizza represents the total value of the crypto project. That's its market cap.
Right.
Now, you can take that pizza and you can slice it into 4 huge, chunky slices. Or you can take the exact same pizza and slice it into 4 million tiny little slivers.
The pizza's the same size either way.
The pizza is the exact same size. So if you buy one tiny sliver for a penny, it feels really cheap. And if you buy one of the huge slices for $10, it feels expensive. But if the total pizza is the same size, you are not getting a deal on the tiny sliver. You're just buying a much smaller fraction of the exact same total value.
So the classic example of this in crypto history is Dogecoin versus Shiba Inu.
The perfect example. Back in 2021, people piled into Shiba Inu because it had all those zeros after the decimal point. They thought, well, Doge is already at 60 cents, but Shiba is at a tiny fraction of a penny, so Shiba is cheaper and has more room to grow.
But that was wrong.
It was totally wrong. In reality, at their peaks, their market caps, the total size of their pizzas, were getting very close to each other. Shiba wasn't actually cheaper, it just had way, way more slices in its pizza, a much larger supply.
And we see this exact same dynamic playing out today in 2026 with coins like Bonk versus Dog with Hat or WIF.
Yes, absolutely. Bonk has a massive supply, trillions and trillions of tokens, so the price per unit is incredibly tiny. Dog with Hat has a much smaller supply, so it trades at a price of over $2 or $3. But depending on the day, their market caps might be very similar.
So if you're sitting there waiting for Bonk to hit $2 like Life did, you are effectively betting on Bonk becoming worth more than the entire GDP of a small country.
You're betting on it becoming worth more than Bitcoin and Ethereum combined. It's mathematically impossible. The numbers just don't work.
So the ironclad rule is always, always check the market cap and the FDV. Which brings us to what our sources call the dark arts of crypto. Tokenomics. You just mentioned FDV, fully diluted valuation. This is where the venture capitalists get you, isn't it?
This is where the game is often rigged against the retail investor if you don't read the fine print very, very carefully. You absolutely have to understand the difference between circulating supply and total supply.
Okay, so let's call this the float, as the sources do. Break down the float for us.
The float is simply the percentage of a project's total tokens that are actually available to be traded on the open market right now. And the biggest warning sign you need to look for is a low float coin. If you're analyzing a project and you see that only 10% or 15% of the total supply is currently circulating, that should be a massive red flag.
But wait, basic economics, right? Scarcity. If the supply is low, shouldn't that make the price go up?
In the very short term, it can. And that's part of the trap. A low float can artificially inflate the price because there isn't enough supply to meet the initial demand and hype. But you have to think about what that 10% circulating supply really represents.
What does it represent?
It means that 90% of the supply is sitting in locked wallets. And those wallets are almost always held by the team and by the early venture capital investors who got in for fractions of a penny.
And eventually those tokens unlock.
The dreaded unlock schedule. Exactly. When those tokens unlock over the coming months and years, those early investors are sitting on 1,000x or 10,000x profits. What are they going to do?
They're going to sell.
They're going to sell. They're going to dump millions and millions of dollars of new supply onto the market, and that will crush the price for every retail buyer who bought in at the top.
We saw this with some really high-profile projects, right? Like WorldCoin and Celestia at their launch.
They are the textbook examples. They both launched with very small circulating supplies. The price stayed high, almost artificially, because there just wasn't enough supply to meet the demand from the hype. But every savvy investor knew the unlocks were coming. It's a ticking time bomb of sell pressure.
So if 10% is a dangerous red flag, what's the sweet spot? What are we looking for in a project's tokenomics in 2026?
As a general rule of thumb, you want to see at least 25% of the supply already circulating. Ideally, you're looking for 50% or more. If more than half the tokens are already out in the wild, the risk of a massive future supply shock is much, much lower.
Our source material highlighted a really interesting real-world comparison between Sui and Aptos regarding this very point.
Yes, this is a great practical application of the concept. Both are high-performance Layer 1 blockchains. They're direct competitors. At the time of the analysis, they had very similar market rankings and valuations.
Okay.
But if you dug into the tokenomics, Aptos had about 46% of its supply circulating, while Sui was down around 27%.
So even if you like the technology of both projects equally, the tokenomics tell you that Aptos has significantly less potential sell pressure looming over its head in the future.
Exactly. The future inflation rate on SUI is much higher because more of its tokens still have to enter the market to catch up to its total supply. Toncoin is another huge cautionary tale here.
What happened with Toncoin?
The market cap of Toncoin, the total value of the project, went up an incredible 25x, a huge success.
Fantastic.
But the price of the coin that you, the investor, held only went up 7x.
Wait, how does that math even work? How can the project's value go up 25x, but my investment only goes up 7x?
Inflation. They flooded the market with new coins from the non-circulating supply.
Hmm.
So the total value of the project, the pizza, got absolutely huge. But because they kept slicing more and more and more new pieces, the value of your individual slice didn't grow nearly as fast.
That is terrifying. You can be completely right about picking a winning project and still make mediocre or even bad returns.
That is the nature of tokenomics. It
I
could be the silent killer of your portfolio.
Okay, let's shift gears. This is maybe my favorite part of the whole deep dive. We've talked about market structure and token supply, but now let's talk about the engine of the market,
Right.
narrative.
Narrative is king. Absolutely. If there is one lesson to take away from this entire conversation, it is this. In crypto, tech does not equal price.
This is the source of so much pain and frustration for so many smart people in this space. I mean, you have people who read the white papers, they understand the cryptography, they can code a smart contract, and then they just have to sit there and watch a green frog coin with zero utility outperform their genius protocol by 100x.
It is the hard and often painful truth. Crypto prices move based on attention, not on revenue or price-to-earnings ratios or any traditional metric. We have to completely separate the idea of company value from token price. They are not the same thing here.
And the comparison our sources use between Eigenlayer and Pepe is the absolute perfect illustration of this entire concept.
It really is. On one hand, you have Eigenlayer. It's arguably one of the most important technological breakthroughs in Ethereum's entire history. It created this concept of restaking, basically using Ethereum's massive security to secure other protocols. It's brilliant, it's complex, and it has massive VC backing.
And on the other hand, you have Pepe, which is a frog.
Pepe is a meme. It's a green frog. It has zero utility. It was a fair launch, so no VCs.
Yeah.
But here is the critical difference. Can you explain Eigenlayer and the concept of restaking to your parents in one sentence?
Absolutely not. No chance.
Probably not. Can you show them a picture of a funny green frog that everyone on the internet uses as a reaction image?
Yes.
Instantly. That's the quote from the source that sticks with me. My mom and dad can understand the frog.
Right.
And that accessibility, that simplicity, creates massive attention. That attention creates a community. And in the world of crypto, community is liquidity. Pepe trades at billions of dollars in market cap because it captured the cultural zeitgeist. Eigenlayer struggles with its price action because it's hard to understand, and it's heavy with future VC unlocks.
It's almost like the easier a project is to understand and explain, the better its token performs in a bull market.
There is a lot of truth to that. It's the retail factor. If the average retail investor can't understand it in 30 seconds, they are not going to buy it. And it's retail money that drives the mania phase of the market.
There's also this really weird paradox that was mentioned in the sources about real revenue. In the stock market, revenue is everything. It's the holy grail. But in crypto, if a project makes too much real revenue and shares it with token holders, it can actually become liability.
We call it the revenue paradox. It's so counterintuitive. Look at a project like Rollbit. It's a crypto casino. It's wildly profitable. They take their profits and they use them to buy back and burn their token. It functions just like a stock buyback.
Which should be super bullish for the price.
It should be, but the price often lags behind the pure hype coins. Why? Two reasons. First, if you have clear revenue streams and you're paying them out to token holders like a dividend, you start to look a whole lot like a security to the regulators. That invites enormous legal risk.
Oh.
And second, let's be honest, many crypto investors aren't here for a steady 5% dividend yield. They're degens at heart. They're looking for a Ponzi-like pump, a narrative that can go to infinity, not a sensible cash flow-based valuation.
We really are our own worst enemies, aren't we? So if we're trying to follow the narrative in 2026, what are the big categories, the niches that actually matter right now?
The market rotates through these narratives. In 2020, everything was about DeFi. In 2021, it was gaming and NFTs. Right now, as we look at the 2026 landscape, the sources point to three dominant narratives: meme coins, AI, and RWA, real-world assets.
Let's break those down. We've touched on memes already, but the sources make an interesting distinction between cultural memes and what they call prediction memes.
Yes, so your cultural memes are your classics, your Pepe, your Mog, things that are just born from internet slang and culture.
Yeah.
But then you have this new class of political coins, the May coins, the Biden coins, the Kamala coins. These function almost like decentralized prediction markets.
So people are betting on election outcomes with these coins.
Exactly. If a candidate is polling well or has a good debate, they're coin pumps. It's a way for people to speculate on political outcomes without using a formal, regulated betting site.
And AI. This feels like the big one that's bleeding over from the traditional tech world.
AI is the intersection of the two most hyped industries on planet Earth. But specifically within crypto AI, the narrative is focused on AI agents, the idea of autonomous bots that live on the blockchain and can transact with each other. It's the perfect narrative because it sounds incredibly futuristic, it has infinite undefined potential, and because nobody really knows how to value it yet, the price can theoretically go to infinity.
And lastly, RWA. This feels like the serious, grown-up narrative.
This is the BlackRock narrative, tokenizing real-world finance, putting things like U.S. Treasury bills or fractions of real estate on the blockchain. It's boring compared to a frog coin, but the total addressable market is in the hundreds of trillions. This is the one the institutions are watching.
So the overarching strategy here is don't analyze the code, don't read the 50-page white paper, analyze where the eyeballs are.
Precisely. Follow the attention.
Okay, so we've identified the narrative we want to play in. Now we need to pick the specific horse to bet on within that race. And this brings us to a very, very painful lesson for veterans of past cycles. The new versus old rule.
This is the graveyard discussion. This is where portfolios go to die a slow death.
I look at my portfolio from the 2021 bull run and I just want to cry sometimes. Why do we hold on to these old coins? Why is it so hard to let go?
It's a psychological trap called anchor bias. You remember when Polkadot was $50? You see it today at $5 and your brain tells you it's so cheap it has to go back to its all-time high. But history shows us with brutal consistency that the new projects from the current cycle typically outshine the old leaders from the last one.
Let's just look at the history of the so-called Ethereum killers. It's a perfect case study.
Go back to the 2018 cycle.
Yeah.
The hot Ethereum killers were Neo, EO, IOTA. Remember them?
Barely. They're ghosts.
Exactly. They are completely irrelevant now. Then you jump to the 2021 cycle. The new shiny Ethereum killers were Polkadot and Cardano. They had their massive, incredible run. Now here we are in this current 2024 to 2026 cycle. Who are the leaders?
It's Solana, Sui, Aptos, the new generation.
The new generation. So it hurts to say it, but structurally, Polkadot is becoming the new EOS.
Oof. Why, though? What is the mechanism that makes this happen?
The problem with old coins is bag holders.
Bag holders.
There are millions of people who bought the absolute top in 2021. They've been holding these bags for years, just praying to get back to break even. So as soon as the price starts to recover, what do?
They sell. They dump their bags the second they get their money back.
They sell to get their money back. And that creates a massive, constant wall of sell pressure that the coin has to fight through just to get back to its old highs.
Whereas a new coin, like a new AI coin that just launched this cycle, it doesn't have that baggage.
Correct. It has what traders call fresh air above it. Everyone who holds it is in profit. There's no psychological barrier of people desperate to sell at break even because there are no underwater investors from 5 years ago.
So the rule, as painful as it might be, is bet on the current cycle's leaders, not the zombies of the past.
It is the single most profitable mental adjustment you can make as a crypto investor. Cut your old losers and bet on the new winners.
And even within those new winning narratives, we have to talk about the power law. You can't just buy a whole basket of junk and hope one of them hits.
No, this is a huge mistake. Winners take all in crypto, much more so than in traditional markets. Look at the gaming sector over the last year. Our sources show Superverse is up something like 1,600%. Most of the other gaming coins are flat or even dead.
And it's the same with the layer ones. If you just held Solana, you crushed almost every other L1 competitor combined.
That's the power law in action. In any given category, whether it's AI, gaming, or memes, the top 1 to 3 coins will capture 90% of the gains for that entire sector.
So don't buy the 10th best copycat AI coin hoping for a spillover effect from the leader.
Don't do it. Just buy the leader. The leader is the leader for a reason. It has the most attention, the most developers, and the most liquidity. The market has already chosen it. Don't fight the market.
Okay, we are getting very practical now. This is the execution phase. We have our strategy, we know what to look for, and now we need to execute the trades. Where are we buying these things? You mentioned earlier that if it's already on an exchange like Coinbase, it might be too late for the life-changing gains.
Yes, you have to understand the exchange hierarchy. It's like a food chain.
Walk us through the tiers of this food chain.
Okay, at the very top, you have Tier 1. That's your Binance and your Coinbase. These are the safest, most liquid, and easiest to use exchanges. But there's a trade-off. By the time a coin gets listed on Coinbase, it has usually already done a 10x or a 50x or even a 100x.
So the listing itself is often the exit event for all the early insiders who got in before?
It's very often a sell the news event. The smart money sells into the hype of the listing. So below that, you have Tier 2. These are exchanges like Bybit, Gate.io, MEXC. You can find newer, smaller cap coins here, but you have to be more careful about the quality of the projects and the security of the exchange itself.
And then at the bottom of the food chain, or I guess the top, depending on how you look at it, you have the DAX.
The Wild West. Decentralized exchanges,
Yeah.
Uniswap on Ethereum, Radium on Solana. This is where the 100x opportunities live. This is where new coins are born and trade before they are famous, before they get any centralized exchange listing.
But it's also where all the scams are.
It's extremely risky.
Yeah.
Anyone can list a token on a DX in minutes. Rug pulls are everywhere. You need to know what you're doing. But if you truly want to follow the insider's blueprint, you have to get comfortable using a Web3 wallet like MetaMask or Phantom and trading directly on chain.
Because if you're waiting for the Coinbase app to send you a notification about what to buy.
You are just providing the exit liquidity for the people who found that same coin on Uniswap 6 months ago for 1/100th of the price.
There's also this other crucial concept of information advantage. It's not just about where you buy, but when you buy. The source material shared a great anecdote about swing trading WorldCoin based on information that wasn't on the front page of the news.
This is a classic example of what traders call connecting the dots. The trader didn't just look at the price chart, they looked at the calendar and the news cycle.
So what were the dots they connected?
They saw 3 separate things all converging. 1, the market was clearly entering a huge AI hype wave. Everything related to AI was pumping. 2, they saw news that OpenAI, Sam Altman's company, was about to announce a massive new funding round. And 3, they dug into WorldCoin's documentation and saw that the project had a major event scheduled for October.
And this information wasn't secret insider information?
No, that's the beauty of it. It was all public. It was in their Discord announcements. It was in their public roadmap. It just wasn't on the front page of CoinDesk or the Wall Street Journal yet.
So they bought before the narrative and the news went mainstream.
They bought the rumor. They built their position weeks in advance while the price was still low. Then, when the event happened and the positive news about OpenAI broke, the retail crowd rushed in, the price spiked to $2.40, and they were selling into that strength.
The lesson there is to look for these catalyst events. Product launches, mainnet upgrades, major conferences. Find the date on the calendar, buy the anticipation in the weeks leading up to it, and then sell the event itself.
Exactly. Don't wait for the price spike to tell you that something important is happening. Find the event that is going to cause the price spike in the first place.
I wanted to touch on technical analysis, or TA, briefly.
Mm-hmm.
We don't need to be wizards drawing triangles and Fibonacci retracements all day.
Please don't overcomplicate it. For most investors, the most valuable TA is just the simple stuff. Support and resistance. Just draw horizontal lines. Identify the value ranges. Where has the price bounced from in the past? That's your support. Where has it been rejected from? That's your resistance. Buy at support, sell at resistance. It's that simple.
And there is one specific tip from Virtual Bacon's material that I think is an absolute game changer for how you view your portfolio. Denominate everything in Bitcoin.
This is so crucial, and almost no one does it. Most people look at their portfolio in USD. They say, oh, look, my altcoin went up 10% today in dollar terms. I'm winning.
Right.
But if Bitcoin went up 15% in that same time frame, your altcoin actually lost value against Bitcoin.
You would have been better off and taken less risk just holding Bitcoin.
Exactly. You took on all this extra risk for less reward. You should view Bitcoin as your benchmark, your savings account. The goal of trading altcoins is to accumulate more Bitcoin. If your risky altcoins aren't outperforming Bitcoin, you're failing as a crypto trader. You're just gambling with worse odds.
That is a very harsh reality check, because if the ETH-BTC ratio is trending down, which it has been for years now, it means holding ETH is technically a losing trade against just holding BTC, even if the dollar value of both goes up.
Correct. So you should always be asking yourself, is this asset gaining Satoshis? If the answer is no, you should probably sell it and just buy more Bitcoin.
Okay, we are in the home stretch now. Let's say we followed the blueprint. We've made our money, hopefully. Now comes the hardest part. How do we keep it? This is section 7, portfolio management and the exit.
This is where the survival part of our guide comes in. This is about making sure you live to fight another day. And to do that, you need a baseline. The core recommendation is the 50% rule.
And the 50% rule is?
Keep at least 50% of your total crypto portfolio in the giants. That means Bitcoin and maybe some Ethereum and Solana. The blue chips.
That sounds boring.
Boring keeps you alive. Boring is what prevents you from going to zero. When the market inevitably nukes, and it will, Bitcoin might drop 20%. But your new small-cap AI coin will drop 80% or 90%. Having that 50% anchor in the relatively safe assets allows you to sleep at night. It reduces your panic during the chop. It's your portfolio savings account.
And what about locking up tokens for yield? You mentioned earlier, stay liquid.
This brings us to the absolute horror story of the Polkadot crowd loans from the last cycle.
Oh God, tell us about this. This is a cautionary tale.
So back in the 2021 bull run, Polkadot had these things called parachain auctions. You could lock up your DOT tokens for 2 years to help a new project win a spot on the network. In return, you'd get a big airdrop of that new project's tokens.
Sounds like free money. A great deal.
It sounded like a fantastic deal when DOT was at $50 and everything was going up. Yeah. But then the brutal bear market hit. The price of DOT crashed 90%. And all of those investors, they couldn't sell. Their tokens were locked in the contract.
You were trapped.
They were completely trapped. They just had to sit there and watch their net worth evaporate, helpless to do anything about it.
And by the time their tokens finally unlocked 2 years later,
the market was at the bottom. It was all dust. The lesson is crystal clear. Never, ever lock your liquidity in a long-term staking contract during a bull run. You need the flexibility to hit the sell button. When the music starts, you need to be able to leave the party immediately.
Stay liquid. Just tattoo that on your forehead.
And one final, very painful but absolutely necessary point on the exit: taxes.
Do we have to talk about taxes?
We have to. In many jurisdictions, including the U.S., crypto-to-crypto trades are taxable events. If you trade your Bitcoin for an altcoin and you've made a profit on that Bitcoin, you owe capital gains tax on that profit.
Even if I didn't cash out to U.S. dollars?
Yes, even if the money never left the crypto ecosystem. And the nightmare scenario, which has bankrupted people, is this. You make $1 million in paper gains in 2026. You owe, say, $300,000 in taxes on those gains. But you don't sell to cover the tax bill. You let it ride.
They're greedy.
You get greedy. The market then crashes in 2027. Your $1 million portfolio drops to just $50,000. But the tax man still wants his $300,000 from the profits you made the previous year.
You are bankrupt.
You are worse than bankrupt. You are in debt for money you don't have on gains that you've already lost. Do not spend your bull market gains before you have set aside the money to pay the tax man.
That is the most sobering and maybe most important piece of advice to end on. It's the advice that saves lives, financially speaking.
It really is. It's the final boss of the bull market.
Okay, let's just wrap this all up. Let's summarize the 2026 blueprint. 1. Identify the trend. Don't fight the market. Don't buy dips in a clear downtrend.
2. Follow the narrative. Ignore the complex tech. Follow the attention and the eyeballs.
3. Check the tokenomics. Avoid those low-float VC dumps like the plague.
4. Bet on new market leaders. Don't marry your bags. Avoid the zombies from 2021.
And 5. Keep at least 50% in the giants Bitcoin and Solana to survive.
That is the checklist. If you follow those rules, you're ahead of 99% of the market.
Before we sign off, I just want to leave our listeners with a final provocative thought to mull over. We spent this whole time talking about value, and we used to think value in this space came from utility, from revenue, from earnings. We would ask, does this blockchain actually do anything useful? But in this age of AI agents and billion-dollar frog coins, it really feels like that whole paradigm has shifted.
It raises a fascinating philosophical question. If money, at its core, is just a collective illusion, a shared belief system that something has value, then are meme coins actually the most honest form of money?
How so?
They don't pretend to have revenue. They don't pretend to be a company or have a cash flow model. Their value proposition is just one thing, stated openly. We are valuable because a community of people believes we are valuable. Full stop.
So value is purely derived from belief.
In 2026, belief might just be the strongest fundamental of all.
Something to chew on while you're staring at your charts.
Well, Smiths, stay liquid, stay smart, and we will see you in the next deep dive.